What is up, traders? This is your homeboy Josh back with another trading video. For today, we're going to be talking about the three best ETF or exchange traded funds to stock up in this year. Let's get into this list that I made for you guys. So first up the list, we have iShares Core S&P 500 ETF. So what does this offer? So the iShares Core S&P 500 ETF tracks the S&P 500. So it includes all the same stocks that the index does and mirrors its performance over time. If you're looking for a safer and more reliable investment, this ETF could be a smart fit for your portfolio. So in general, they are incredibly consistent. In fact, analysts at a certain research center examined the index's long term performance and found that for every single 20-year period in history, the index ended with positive total return. So if you had invested in this ETF, so and simply held it for 20 years, you would have made more money. So again, this is a very popular ETF, although these factors might look red right now, but in a 20-year span, if you invest here, usually the outcome is very good, like it's very positive. So moving on, we have Invesco QQQ Trust. So this is a growth ETF containing primarily tech stocks. It tracks the Nasdaq 100 index, which is composed of the 100 largest non-financial companies listed on the Nasdaq. This fund was launched in 1999, making it one of the older ETFs in existence. It also has a history of beating the broader market, which is very good, right? Over the past 10 years, the Invesco QQQ Trust has averaged a total rate of return over 17% per year, which is very big. The other ETF that I have just discussed for comparison earned an average return of just under 12% per year in that time. So this has returned um a bigger result over the previous ETF that I've discussed. So lastly, we have Vanguard Growth ETF. So this occupies somewhat of a middle ground between the iShares and the Invesco. It's designed to earn above average returns over time, but it also has ample diversification. This ETF contains 221 stocks, which is a lot, and its composition is split between smaller and high growth companies and blue chip stocks. Its 10 largest holdings make up around half of its total value, and these stocks include major names like Apple, Microsoft, Nvidia, and Visa. The other half of the fund is made up of smaller stocks with the potential for explosive growth. Balancing solid companies with up and coming stocks can help limit your risk while enhancing your potential earnings. So, guys, back to the question, why are these the best? Because I these ETFs have very good returns. However, going back to the consumer side, why, I mean, which one should we pick, Josh? Actually, it will all boil down to you. Like, what would be your risk appetite? Would you be conservative? Would you be aggressive? Or would you be somehow a little bit in the middle? So that's where your decision should be based off. Even though, the figures here might attract you and such, although the figures here are actually still a factor for your decision, but the bigger factor and the more important factors lies in your hands. All right. So if you are somewhat conservative, you should choose this one. If you are you feel a bit aggressive in investing and you have a lot to invest, you could choose the more aggressive one. So basically the decision will all boil down to you. You just got to make sure that you're well informed and you have the knowledge of each of these ETFs so that you would make a very good decision in your financing. So that's all for today's video, guys. Thank you so much for watching. Please don't forget to like, share, and subscribe, and stay tuned for the next videos. This is your homeboy Josh again, out.